So friends, welcome back. This is part 3 of my lecture on the accounts. Here, let me explain to you the basic difference between the accrual base of accounting and the cash base of accounting. So in the case of cash base of accounting, the figures or the transactions appearing in the receipts and payments account, which is a cash account, is only reflected in the accounts. So any receipt or any expenditure which has actually happened, whether it actually pertains to the period of accounting or not, even if something is received, wrongly, or something is received in advance pertaining to the previous year, or if something is paid pertaining to the previous year, the income of the previous or previous years. So as and when something is received or something is paid, only then it is accounted in the cash base of accounting. Whereas in the accrual base of accounting, it is not so. So the prepaid expenses, the outstanding expenses, the accrued income, although we have not received, but if it has accrued, or the unaccrued income, even if it is received and not accrued. So all these things are taken in the accrual base of accounting in the balance sheet. And the income statement, because you are considering the prepaid expenses, accrued income, etc., it shows higher income in the accrual basis. Your income is more because you are taking even the accrued income, although it has not actually been received. Whereas in the cash basis of accounting, as far as this aspect is concerned, the income reflected would be less. And in the accrual basis, it would be lower income because the outstanding expenses, the unaccrued income, etc., are also taken into account. And the accrual base of accounting is recognized under the Companies Act 1956, whereas cash base of accounting is not recognized under the Companies Act 1956. And an accountant has options in the accrual base of accounting to manipulate the income by choosing the suitable approved alternative, whereas there are no options for any such manipulation in the cash base of accounting. So these are the main differences. And then what are the weaknesses in general in the accounting system? See, accounting statement is always a recorded information. There is absence of qualitative information. So how efficient is the working force or how good is the equipment that you have? No. The accounts cannot really reflect these qualities. And it also depends on the personal judgment sometimes. And the inflation is not taken into account in the accounting statements. And different groups require different information for different purposes, so you cannot prepare a common statement of accounts meeting the requirement of all the people. And there are varied accounting policies approved, varied accounting policies with regard to the depreciation, with regard to the valuation of inventory, amortization of deferred revenue, etc. So depending on the method that you have adopted, the policy that you have adopted, your accounting statement also differs from the other company, which has followed for the same value a different policy. So comparison becomes therefore difficult, and therefore in our accounts you will have to declare what is your accounting policy, and the accounting statements are to be read in conjunction with the accounting policy adopted by the organization. These sources of information for compiling the accounts are the vouchers, the receipt books, the transfer entries, the journal vouchers, similarly the bills receivables information, the bills payables information, books of accounts. So these are the sources of information for the preparation of accounts. And what does capital budget in the government comprise of? See, the transactions relating to the building, capital equipment, the plant and machinery, the market loans, borrowings from the Reserve Bank, borrowings from the other national and international financial institutions, the loans and advances granted to the state governments or the government companies, government undertakings, also government's investment in shares, etc. So all this forms part of the capital budget in the government. Let's see what is capital expenditure and revenue expenditure. The expenditure that is incurred with the object of increasing the concrete assets of the organization, or that incurred with the object of reducing the recurring liabilities of the organization, is considered as the capital expenditure. So the capital expenditure and revenue expenditure, the difference we can put it like this. Capital expenditure is that expenditure which is incurred to acquire or bring into existence an asset. So it is that expenditure which is incurred to acquire or bring into existence the benefit of a lost longing nature or the enduring nature. Expenditure incurred to increase the productivity or the earning capacity of the organization. So it normally yields, this capital expenditure normally yields the benefits beyond the current accounting period, maybe for the next 5 years, 10 years, 20 years, like that. And this is debited to the respective asset account, the capital expenditure. Whereas revenue expenditure, it is incurred to maintain the productivity or the earning capacity of a business, to carry out the operating activities of the business, and it does not normally yield any benefits beyond the accounting period. And the revenue expenditure, it is debited to the profit and loss account or the income and expenditure account. Then what is depreciation, the depreciation accounting, etc. We will see in the subsequent part, that is part 3. So thank you friends. We shall close part 3 here.